The recent news has been dominated by the war in the Mideast that has replaced the war between Ukraine and Russia. But there's another war going on in the investment arena, which most people are unaware of. It's between Schwab, Vanguard, and BlackRock. And today we're going to discuss fees and more fees, because that's what the financial industry works on. My name is Don Creech.
And I'm Perry Sykes, and welcome to the Investor Resources Podcast.
I thought about titling this Promises Made and Promises Kept, but I thought that had too much political connotation to it because of President Trump. But basically, we can't apply that to Charles Schwab and Company. Charles Schwab, with the early advent of exchange-traded funds, as they became popular, committed to being the low-fee provider in the exchange-traded fund business. And they have kept their promise. When Vanguard used to hold that title, and people bought Vanguard because they had low fees. They didn't care if the performance was worth squat. All they knew is Vanguard has low fees, and that makes a difference over an extended period of time. And it does over an extended period of time. So if you're a 20 and 30 year buy and hold investor, you want to pay a lot more attention to that. However,
like you said, Don, low fees are good for everybody. And that's a trend that's been in place at Schwab, and it's stayed in place. And to Schwab's credit, it hasn't been a smoke and mirrors reduction in fees where they go down one place and up somewhere else. They've been lowering fees across the board for all of their investors, and that's a very positive thing. From a company point of view, just looking at someone to do business with, they really are making it less expensive for investors to invest, and that's a good thing.
I remember back in the 80s, let me make that the 90s, because I hadn't abandoned my brokerage affiliation in the 80s. It was 1990 when I did that. So sometime in the 90s, after I was running this company as a fee-only registered investment advisor, I looked at my fee schedule and said, we're going to change what we do. And I have, of course, have everybody sign off on an acknowledgement. And I remember a physician client of mine saying, well, what's this do? Raise your fee? I said, no, actually, this reduces my fee. And here, I'll show you. I mean, he was beside himself with disbelief that somebody would actually cut his fee.
How can that be? Yeah.
And that's actually what this latest announcement from Schwab is doing. They are cutting their own revenue on their assets under management by $20 million. And if you're an investor in Schwab stock, you're saying, well, how can that be good? We want money coming in the door because that's how they make profits. Well, they also make profit by having a larger client base, and lower fees attract investment advisors such as us and individual investors, perhaps such as you, to stay in the fold. And so they, on a smaller margin with higher volume, they're still going to be profitable, even though they may take a short-term hit. But this challenges BlackRock and Vanguard, who have been reluctant to lower their fees, but have been forced to do so because of competition from Schwab.
And it's one of those things you can't hide. It's very fee structures are very visible to the investor, so you can't pretend it's not there. And no one these days can come out and say, yeah, but our service model is so much better. Everybody pretty much offers the same services. So right now, the fee is the big thing. And over time, if you want to, give yourself more margin for error in your investing, one of the ways to do that is reduce the costs that you're incurring. And fees are the primary cost right off the top. And Schwab has been doing a great job of being the low-cost provider and still providing quality products, good service, good execution. And those are the things you look for. Those are the things you need. And then other companies have to at least stay in step. They don't have to beat Schwab on the downside, but they're going to have to lower their fees also, because it's just a waterfall effect. Once it starts, then then the next person goes down, then the next one goes down, and all the fees go down across the board. So it really is good for the entire industry, and we applaud Schwab for being at the forefront of that.
So one of the ways they do that is they focus on broad index funds. Schwab is not a provider of sector or theme based investing.
Correct.
If you want to do that at Schwab, you have to go into individual stocks or you have to do business with non-Schwab sponsored funds. Because you go into those funds, for instance, you want to buy an oil fund or a cybersecurity fund or a fund in international securities, which is where they just made a big drop in their fees. You need to be looking at other sponsors, and you will find that their internal fees, and there's multiple things to look at there, are actually higher than buying
Sure.
a well-structured, computer-managed index fund, which is what Schwab has. They aren't paying any high-priced name. I think of Peter Lynch. Peter Lynch is not going to run an index fund.
Correct.
They can't pay him enough to do that. There's not enough money in the transaction.
It's not going to happen. And so Schwab's decided, well, I can attract money managers who are bringing in their client base, and I don't have to market to individual investors, which they still do. But this channel for them, the registered investment advisory channel, is a great income stream for them, because firms like ours will come there with our client base and say, well, let's do business with Schwab. It's the least expensive option. We're still getting great service for them. We're still getting great execution in trading, and we're getting the lowest cost. So it makes us look good. It makes them look good, and everyone that we do business with is happy about it. So it's really a win-win situation, and it is a volume decision. You know, we're gonna make a little bit less, and we're gonna try to keep increasing the number of people doing business with us. So that's the drive behind what they're doing, and they're doing a great job right now.
Well, and part of their argument for being in passive funds, which is what they are,
sure,
is that the academic work on investing is that passive management outperforms active management. Now, it's always done on an absolute scale from point A to point B, and it's not done on a risk managed scale. So a lot of active managers, when you factor in the portfolio risk, actually have better returns. Because what investors seldom recognize and understand is, for passive investing to work, you must hold your portfolio to the bottom of 30 and 40 and 50% drawdowns, where active managers will provide you with some cash or bonds or some other defensive asset through that period of time. You're going to incur some reduction, perhaps, in absolute value, but it will slow the erosion and give you a better place to avoid making a panic selling decision at the bottom. So most investors never actually realize the benefit of passive investing because emotions overtake reason.
And that's one of the reasons that having those defensive options is so important in a client portfolio, is because of the emotional side. A lot of times, it's not just the drop in the market. It's that, as you mentioned Peter Lynch earlier, Peter Lynch used to always say, never let the market scare you out of a good position. And oftentimes, individual investors just get scared. The fear factor increases enough that they're like, this is not worth it. I can't sleep at night anymore. I got to get out of here. And they'll abandon their positions across the board. And it may take them a decade to decide to get back in again. And that is highly costly. The opportunity cost of losing that time is quite high. And so being a little defensive, being out of the worst parts of the market at the worst times to be in them, that can keep a client engaged, keep in the portfolio, and be there when the recovery happens, instead of being on the sidelines, unable to make the move to get back in the market. We try to avoid that.
Well, given the current situation with what's going on in the Mideast war, that's actually a highly motivated decision maker for many individual investors.
Sure, you bet.
We had an email this week that just basically said that I'm scared. I don't want to be in the market. Get me out of here. And then we turn around and look at what is in the portfolio. And with the exception of one position, everything in that portfolio is going up. with one exception. Well, nothing works all the time every day.
That's pretty good. Yeah, yeah, that's pretty good. So we'll take that.
And the other part of the response was, I want to be in something safe. Get me in a bond portfolio, 100% bonds of my portfolio. Well, I wrote back with a couple of charts and said, bonds have been in a bear market since the summer of 2020, 4.9 years of losing money in a safe investment. That's why we don't own bonds. we own bonds periodically when they're going up in value. It means interest rates are falling. But with the Fed saying they're not going to lower rates, and if the tariffs become the realized fear that the Fed has, which we don't think is rational, but that's the fear's position, well, then they're not going to lower rates, which means that we're going to extend the bond bear market into a full 5 years. Yet people think that's their safety valve. The issue is to look at things upside down, invert the decision. If I do this, what damage is it likely to provide? How am I going to lose money on this? Where's my stop loss on this decision that I'm about to make? I do counseling with other advisors around the country every week, and they are often asking about new positions. And I say, it's going up, it's got a new high, but where's your stop loss? If this goes against you and you've got client money on the line, where are you going to get out so you don't take a big hit? Just because you believe it's good and you have justification on your technicals and whatever fundamentals you did, doesn't mean it's going to work. It means the probability's on your side, but when it goes against you, how or what will make the decision to force you to pull the sell trigger and protect your capital?
And that's a very important point to have in your the set of rules you use to invest by. Whenever you buy anything, you have to know in advance, what would it take to make me sell this? If this is not working, what is it that I'm going to look at that's going to make me decide, okay, this is not working in my favor, it's time to go? And it's important to have those set ahead of time, because a lot of times when things move against you, when things are being a little negative, it's hard to think clearly. People get scared, and it's hard to make a rational decision. That's when you need those rules in place to let you make that decision, and then more importantly, do it. Be disciplined enough to make that sell and move on to something else.
So let's go back to the fee issue for just a moment. There are times when if you're actually running your own account, just because something has low fees doesn't mean that's what you should own.
Sure.
You turn around and look at what's actually performing in the market, and we have different sectors that are actually outperforming the major indexes. And right now, that's predominantly in the technology area. But you have technology, which has, I think, 11, maybe 13 subcategories. So you don't have to be tied to just a broad index like QQQ. You can buy something that's in semiconductors, SMH or SOXX. There's a variety of them actually in there. You like the semiconductor area, which is doing very well and outperforming the index, you're going to pay a higher fee. Now, you're not buying this for the next 20 or 30 years, typically. This isn't for a retirement account. This is because you're capitalizing on certain shorter-term trends. Now, those trends may be 2 or 3 years, but they're concentrated in a specific type of asset class. When you're doing that, you're going to pay a higher fee. Now, you still want to pay attention because you have multiple choices typically. There's multiple semiconductor exchange-traded funds and mutual funds that are also industry-specific, and they're going to have fee variances. So you should take a look at them. And performance changes over time. I mean, this morning I had an individual call me. He's what we call an inside wholesaler, calling to tout his particular group of funds, which we use from time to time. And he said, but over the last year, our fund has outperformed the one you're holding. I said, what about the last 60 days? And he looked it up and he said, oh, not so much. You're better off where you are.
Thank you.
Yeah. I said, you don't need to call me If I need information, I'll call you. That's because I've done my own research first instead of accepting a concept story or a theory or a theme. One of the themes that's not working well lately is the clean green energy theme. It's doing terribly in Europe, where they're finding significant problems with green energy. The tax benefits look like they're going away. So the companies that have been benefiting from tax benefits are finding it virtually, well, I won't say virtually impossible, but very difficult to maintain profits without the tax feature, which means the credibility of the concept was political rather than real business demand.
Right. Not working. In fact, the theory doesn't matter. In fact, it's not working. So
there are factors to pay attention to, but during the period of time where green energy mutual funds and exchange traded funds were doing well, you paid a higher fee to be in them. And if you don't have rules to get out of them, you're probably still in them. And what you thought was a good deal is evaporating because you're not paying attention or don't have rules.
Yep.
One of the two. Well, maybe there's a third reason, but in any event, our point here is that fees are important to pay attention to, but there are other things that are also important in running a portfolio that's going to provide you with peace of mind. If you have stop losses, you know when to exit. You're gonna have peace of mind, knowing that you're not going to get blindsided, or at least you reduce the risk of getting blindsided. Reduces anxiety, and you make better decisions. And that starts with asking, what could go wrong? And what do I do about it if that happens? And if my research is right, it will go right, and I'll be a happy camper. But I don't want to be waking up one day and finding out the portfolio doesn't have anything in it.
Never a good day there. Yeah.
Yeah. So if you want to continue this discussion with us, you can give us a call. Phone number is going to be on the screen. You can send us an email. We'll be glad to chat with you. Subscribe if you haven't already. We have more coming. Have a great day.